Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, January the 8th, and I hope everyone had a wonderful holiday season. It's great to speak to everybody this year and do something a little bit different today. I normally give you what the last week's performance was for each index, and I thought it would be good to kind of, since the year ended, just give a year-end performance for each index that we track here. So the S&P 500 was the winner for the year, which it was another double-digit up year. So you had two 20+% years and now a 16.4% up year for the S&P 500. It was indeed up 16.4% for the year. The mid-cap index did lag behind. It was up 7.5%. And the small caps as measured by the S&P 600 were only up 6%. Now, if you track the Russell 2000, that index was up significantly higher, and that is because to be in the S&P 600, you have to be a profitable company and show 4 consecutive quarters of profitability. And in the Russell 2000, you have some more speculative small cap names and maybe some tied to AI, and that's what's seen that big growth and the difference between the two indexes, just to explain why. So as we move into 2026, that's all great news. We've had 3 great years of runs in the equity markets. That's wonderful, but that's all behind us. So what does that mean for us moving forward into 2026? Well, believe it or not, the first 5 days of the trading year tell us a whole lot, and today is that 5th day. So let's talk about what that means for you and your individual portfolio. So if the equity markets, specifically the S&P 500, finishes positive after the 5th trading day of the year, you have a very high likelihood of a positive January and a positive year. And the high likelihood is somewhere between 70 to 75% chance. It is what is known on Wall Street as the January indicator. And again, that's the first 5 trading days. And so as we fast forward into 2026 on the 5th trading day, the Dow's up right now, the S&P's slightly down, the Nasdaq slightly down. If things finished as we're speaking today and the day closed right now, it would be positive for the first 5 days of the year, which is another positive indicator. A lot of other historical things we can point to as to maybe the 4th year of the bull market is typically a good year. You can look at many different things, but wanted to talk specifically about what's currently here and why we see things going higher into 2026. And there's 3 main reasons we see that. Is number one is earnings growth is continuing to accelerate and move higher. And remember that at the end of the day, earnings and earnings growth is what moves equity markets higher. If you don't have that earnings expansion, then you just have price multiple expansion. You're not seeing real growth. The other thing is the Fed is actually easing its monetary policy some. It's not what a lot of people are talking about at the moment. Many people are just focused on how many rate cuts, but the Fed is going to be buying bonds, and that is quantitative easing, and that is putting more money back into the system. And so that in itself is stimulatory. And then the other aspect is we are moving into where we expect there to be a lot of tax refunds this year into 2026, which is a very stimulatory activity for the economy and equity markets. We believe we've muddled through a slow time in the back end of 2025 through the economy, and we believe that we are in a place where we could really see things start to accelerate, maybe even into the back half of 26. So there's always things that can come along and derail markets, but as we sit today on the 8th of January, we're in that 5th day, which is positive. So chances are we're looking good for 26. But the other thing to touch on too is that the money flows for the equity markets remain very strong and positive. And what's healthy about what we're seeing in the underlying markets is an overall broadening out. So for the past 3 years, the real leadership has been the AI and the AI trade, and of course, reasonably so. It's things to be excited about. It's where the growth is going to be. But at some point, that growth gets priced in, and there needs to be a period of digestion. And what you're seeing is that happening to some extent in the market. And the companies that have been left behind that are much cheaper, that have been growing their earnings, are starting to play catch up. And so expect that to be maybe the trend for 2026 is a broader market, not such a narrow growth tech market. So if you have questions about how to navigate 2026 or how to get started in your plan for the year, or just have general questions about, I just missed these last 3 years, am I too late? We'd love the opportunity to sit down and explain that to you and talk you through everything and tell you how it's not too late to get into the equity markets, and that it's a place where you want to be and want to be moving forward. So you can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thank you so much for watching.